we're seeing a multi-trillion-dollar market in tokenized assets come to the fore, and depending on what paper you read, by 2030 or 2033 or whatever people want to quote, but I see this as it's $1 trillion opportunity into the double-digit trillion opportunities on the optimistic end. And if we get all tier one and all tier two institutions firing on all cylinders by 2030 to 2035, then that number of double-digit trillion could easily grow into the 100 trillion.
I always get a bit shy when I'm doing these kind of things. So
no worry.
Well, hello Neil. Welcome everyone. This is episode 3 at the On-Chain podcast, and joined by Neil today, Neil Batchelor. So I've been in communication with Neil for roughly probably about 4 or 5 months now, with the kind of several positions and whatnot. He's very knowledgeable across tokenization, RWA, digital asset management, and in general the kind of the historic or the old world finance, shall we say, and where things are heading. So I'll give you a couple of minutes. Sorry, Neil, just give us a bit of an overview of your who you are, what you're about.
Yeah. Thanks very much, Toby. Really appreciate it, and look forward to speaking on these topics. So I spent 25 years in capital markets, 10 years in blockchain so far, working both on my own infrastructure startup. I've worked for asset managers, custodians, and a number of other different financial institutions. And at the moment, I'm consulting for tier one banks and asset managers, and certainly the landscape's really interesting at the moment. There's lots to talk about.
Yeah, certainly, and I think it's definitely going to be someone that I'll be getting on a couple of occasions, because it's difficult, isn't it, to really cover everything in one call. But I mean, the focus for today is really surrounding kind of custodians within digital asset classes, and where RWA and tokenization essentially comes into play. What the benefits are of tokenization. So I mean, before we kind of delve too deeply into that, are you able to just give us a kind of a real kind of overview of what RWA means to the working day man, and effectively where you think the potential of this industry is?
Yeah, so I think you could characterize RWA very simply. Real world asset tokenization means the tokenization, or placing the asset, tokenizing the asset onto a blockchain or multiple blockchains. That asset happens to be asset backed. It could be a financial product, instrument, or a real world asset. And that's primarily, it's done for a number of different reasons, and there are a number of different benefits associated with that: efficiency, cost reduction, liquidity, collateral mobility, investor value, new revenue, distribution. We can talk about all of those things, but really it's just representing traditional finance and traditional assets, be they physical or digital, on the blockchain.
Yeah, brilliant. I mean, one of the things that when I kind of first started learning about RWA, the thing that kind of really pulled my attention towards it was the fact that you could, in theory, in a couple of years further down the line, maybe you'll be able to buy our houses using this kind of method. And I know that certain places around the world are effectively, trying to implement that, certainly in the Middle East, aren't they? Yeah, it's quite exciting.
I think there are a lot of companies early on really focused on things like tokenization of real estate, and that is a market that's been steadily growing over the years, right? At the moment, I think that market stands around, for tokenized real estate in particular, stands around 200 billion in issued assets, maybe slightly more. And I think it's certainly an area that we will see an awful lot more activity on, and certainly provides investors with an alternative to traditional REITs.
Yeah, and from your background, obviously coming from the kind of the tier one banking environment, are you starting to see kind of a big shift in kind of the way that the money markets are working and RWA? Do you really kind of see that as becoming a forefront moving forward?
Not a massive shift, right? But I think that this is a gradual change that's snowballing, where we're clearly seeing now many hundreds of billion of assets put on chain. We're seeing at least more than half of tier one institutions, even tier two institutions, actually looking at this and various different related topics. So I think we will see an increasing amount, and I believe that we're at or near an inflection point where we'll see an awful lot more different kind of assets on chain, different kind of products, bonds obviously already on chain, private credit, which is and asset-backed finance, which is a speciality of mine, on chain. We've already seen a significant number of money market funds on chain, and that will continue to grow because it's a fantastic use case. Clearly, we have also a stablecoin market that has now grown to 320 billion, and I think at peak there's more processing volume there than MasterCard and Visa put together. So that kind of shows you that when the market's really working well and enthused to change and transform, that really significant things can happen.
Yeah, no, it's really the endless capabilities of the on-chain environment is brilliant, isn't it? So what we'll do, we'll move into kind of the more the structured questions we've agreed. So to kick things off, so institutional investors, money managers and broker dealers, so they all depend on custodians and other market participants for the effective handling of securities and digital asset portfolios around the globe. So in kind of, you know, your opinion, how does the role of a custodian change in response to digital assets? And I suppose really and do you feel digital assets are really kind of changing the way that investors are looking at things and how essentially everything's managed moving forward? And we'll move into the more tokenized aspect of that further along. But what responses has happened recently to really kind of ensure that these custodial changes are happening?
Yeah, absolutely. So I think it's worth just stepping back and understanding like the change that custody, traditional custody, has been through already, right? And at this point, we're on about custodian 3.0, 4.0, 5.0. I couldn't even really count on your perspective, right? I mean, we've had significant business model disruption over the years, increasing margins. We've had regulatory and compliance reform. We've had migration to cloud. We've had the need for new data rails, data architecture, and just general digital transformation and change, like renovation of existing landscapes, platforms. And we've had other things like real-time exposure and margin monitoring cross portfolios. So, you know, that's a major technological change and product offering to clients. And then, of course, we've got digital assets, and we have also kind of AI also, coming down the path. And I think the answer, therefore, when you consider all of that change and all of those gates and milestones that custody has been through, is that the role hasn't really changed, but the underlying technology has. And client expectations also haven't really changed. And expectations are to lead in all areas of the product and the service. So the core responsibility of a custodian, whether it happened to be a traditional custodian or digital asset custodian, is safekeeping, trade processing, and asset servicing. They're the core tenets of custody, right? And that implies assets and capital are relatively static. However, clients expect the best technology that allows them to take advantage of new platforms, new markets, new strategies, and help them maximize those opportunities, all whilst minimizing their risk, right? So a custodian really, at its also at a foundational level, offers those core tenets, whilst also supporting clients' investment strategies. And that's something that investors, issuers, multiple counterparties alike, that's their core expectation. And I think also Zodia recently came out with some really interesting numbers for digital asset custody, and I think it's a foundational layer to other services that are then layered on top, where demand for that digital asset custody, because custodians are regulated, they have exclusive control, they are insured, etc. But we should expect, as institutions come into the space, that custody grows by about 5 or 10x over the next decade. So, and I think that is going to be true of transformation within traditional finance, as well as the growth supplied by digital asset finance, right? And I don't think you can really run a viable financial services business on custody fees alone, however, because they face compression, and they have done since inception. There are a number of traditional qualified custodians, Bank of New York Mellon to HSBC, that have experienced significant compression. Many of those still lead the way and lead the market, and existing digital asset custodians all vying for that future business at a time where, thankfully, we're seeing ever more of that regulatory clarity. So, for me, the space has become more demanding and more competitive. And within digital assets, that means transforming into a digital assets financial service provider. Just to qualify what I mean by that, I think that means, seamless onboarding, embedded compliance, all of the table stakes operations, safekeeping, trade processing, asset servicing that I mentioned that are of paramount importance. A broad asset coverage, multi-asset class, access to trusted markets, trusted venues, reputable counterparties, largely exchange-traded markets as they are now, digital assets, but I think OTC more and more in the future. Access and servicing of yield opportunities, such as staking. I think improved data capabilities and improved position data for multi-custodial strategies, because I also see, clients looking at multiple custodians to procure multiple custodians at any one time to mitigate their risk. Added to that, you have payment rails through stable coins, and stable coins are underpinning treasury and instant settlement and yield. So that's obviously important whilst assets remain in custody. Other innovations include off-exchange settlement, and custodians play a key role in reducing counterparty risk. and enabling yield on collateral, and access to capital and lending are a must for the future. In digital assets, we must grow our lending markets and our credit markets or options in order for the economy to really fly and grow, as we've seen in traditional markets. Collateral management, a greater volume of assets seen as eligible collateral that you can trade, that you can lend with. A custodian and its partners play a key role in transforming collateral movement and mobility, maintaining that mobility and enabling pledging on any loan or any trade within a certain rule set. And I see the as a service business becoming more prevalent. So, this is something I was talking about a couple of years ago, where compliance or regulation as a service, tokenization as a service, stable coins as a service, right? And these remain open opportunities for custodians, and they're certainly, making the most of these opportunities.
Yeah, certainly. I mean, so it almost sounds like to be a successful custodian and really kind of have that market share, you almost need to have your own technology. You almost become like a technology provider for all of these silo areas, and have like a real strong infrastructure based layer there, and a reputable sort of image in the market to essentially draw consumers in. And I think we spoke quite a bit about this when we met in London a couple of weeks back. The kind of the historic names, and this is where that it's quite difficult for the new guy on the block to really establish himself with that. With a brand in such a competitive market, with the staking and yields and etc., all of the elements you need to now have to be successful.
Yeah, absolutely. So I think that it's a controversial thing to say, but I think that we will see those traditional custodians come to the fore and dominate the market, because ultimately a lot of it is about trust, right? And who do you trust, right? And in the worst case scenario, how are clients perfected? And ultimately, that's trust still lies with, yes, some of the very best performers in digital assets, but it also lies mostly with, the top 10, top 5 custodians in the world. And they largely remain the same, back in New York, Mellon, State Street, etc.
Yeah. I think in one of the earlier podcasts we spoke quite in a little bit of depth around a kind of cultural attitude, and we kind of touched on it there, buying languages, etc. Like historic players now, and I kind of made a bit of a tongue-in-cheek joke around a bit on LinkedIn with the vultures from the Jungle Book, getting involved in these markets, and I feel like it is starting to come apparent, in particular, like you mentioned earlier, stablecoins has really kind of opened the floodgates, right, to a lot of the kind of high street names, if you like, getting involved in the blockchain and on-chain activities. So in terms of moving on to the kind of tokenization elements, then. So RWA is essentially unlocking capital from like traditional assets and alternatives. What role do you think institutions need to play to drive it towards more efficient global markets?
Yeah, I mean, I think institutions play a key role in all areas with respect to tokenization. So first of all, you have to originate sets, you have to originate transactions, right? You have to process those transactions, and you have to issue and distribute those transactions. You then, in relation to how settlement works, you have to be able to manage the redemptions on all of those things. So there's several key roles, and there's also other roles that are go more unnoticed beyond origination and distribution, such as payment agents, operations agents that are able to process transactions on clients' behalf, etc., right? So there's lots of different roles within that ecosystem, and I think that, you know, what the ecosystem lacks at the moment, or has in some part, but not in all parts, is the origination of quality assets, right? To be able to tokenize and to be able to offer return on those assets. And so, you know, illiquid assets like real estate, like private equity, like private debt, and general. This is kind of focused on alternative assets, but not necessarily exclusive to alternative assets. You know, you have to have production-proven mechanisms for fractionalization, for 24/7 secondary markets, for programmable transfers, to be able to atomically settle T+0, to be able to transfer funds where and when required, and I think a lot of these aspects, you know, should not be underestimated as kind of transformational within the market. The TradFi market's going through a massive change at the moment in terms of its settlement cycles. And many regions, jurisdictions, countries progressing to T+1 settlement, and kind of unified settlement timeframes, if you like. And I think, you know, blockchain, well, I know that blockchain has the ability to settle trades simultaneously, delivery versus payment, and eliminate any kind of multi-day exposure. You know, failed trades, capital tied in settlement risk. You know, this actually could free more capital than has currently been issued in assets on the blockchain to date. So, and we're talking about hundreds of billions that this would kind of positively impact. So a lot of the time we want to focus on the front, we want to focus on the trading, the lending, the venues, market makers, OTC desks, and a lot of the highlights. But we should not forget the kind of settlement processing, the middle and back office of all of these things, right? And just to give you some economics, really, I think, because, you know, we just take a fund in finance that investors may invest in. A traditional fund's costs are projected to rise by a third over the next 3 years, right? And tokenization, the ante to that is that tokenization is expected to cut those operating costs by about 20%, maybe even 25%. I would argue that if even less of that fund was off-chain and more of it was on-chain, i.e. having full life cycle management on-chain, that we could cut the costs by 75%, right? And that's equivalent to a significant percentage of assets under management for asset managers and funds, right? And for the average fund, tokenization delivers a total P&L improvement, I think, of between 3 and 8 million a fund, right? But mainly because what you have is you have a significant amount of capital to be able to start a fund, which will decrease, right? The average seed capital required to start an investment fund, UK, whatever, is about 50 million. And I think that will go down significantly into the high 30s. And I think when we look at industry-wide impact across UCITS, UK, US mutual funds, we're looking at a kind of 135 billion saving from all of the performance improvements. And if you can reduce like what's called the total expense ratio for investors, you suddenly get, a lot of, and you're saving, 64% of as much as 64% of your operating cost in the back office.
And
then
is that
you get a lot more interest from investors.
Yeah, I mean, you can say, the one thing that grabs people's attention more than anything is cost and saving, cost and time, isn't it? I just wanted to kind of understand, where does to achieve that, is this done by kind of implementing a real kind of the smart contract kind of idea at the start of these sort of funds, and that kind of that kind of rule of thumb will manage it, or how do you go about that in comparison to older methods, should we say?
Yeah, so I think that it's also about looking at the heart of blockchain technology. So where do the savings come from, right? The heaviest cost buckets are the middle and back office cost buckets. The transaction monitoring and processing, fund accounting, corporate actions, reconciliations, transfer agency, oversight and governance. Now, what happens when you put automation and blockchain together with programmable rules? Actually, you can start to reduce a lot of those costs through automation and through proper use of the technology. And I think, again, if you can reduce those costs, you can then reduce how much the entry cost for investors, and you can increase competitiveness. Through increased competitiveness, on that lower cost barrier, you get higher inflows, you're going to get a revenue uplift. And I think that revenue uplift is in the millions per fund, right? In the millions per fund. And so faster, cheaper fund launches, fund managers, more responsive to market opportunities, testing new strategies, lower risk, and they can dramatically improve distribution and reach into wealth platforms, DeFi, on-chain investors, right? Because, the tokens that are being created, and I can talk a little bit about it, are, and it's not all positive, so there are a few hurdles, right? But the tokens are digital and programmable in nature, right? And that's obvious. But and so therefore, if you have an investment and you want to represent that on chain, and you want to run that on chain through smart contracts, you can do that, right? And that's one of the things that I've been really focused on this year, is a on-chain platform, basically a debt capital markets middle and back office, to basically transform private markets and alternative assets for mid-sized corporates and other counterparties. And why have I done that? Because I'll come to the kind of barriers on the adoption side. Really, what I'm trying to do is I'm trying to make blockchain technology easier to use, more understandable, so that clients and counterparties, financially savvy entities, right, and professionals, they don't want to be writing code, right? They don't want to be writing code. So actually, how can they do what they need to do every single day? How can they take advantage of the benefits that blockchain gives them without having to do some massive, integration, significant transformation, significant enhancements to their existing platforms, etc., etc. How can they realize that? Because amongst the asset managers that I speak to that are not fully on blockchain at the moment, although they are definitely exploring blockchain, and about 60% are, right, and 40% are active, about 40% are exploring. About half of those cite deployment cost and the ability to use the technology as as one of their biggest obstacles, and about a third point to the technology or feature limitations or just general barriers of understanding to actually adopting it for relating it to their business and understanding the business case, understanding the benefits, right? And so I think we've got a lot more to do in providing professional friendly platforms that financial professionals, managers, asset managers can use, fund managers can use to basically tokenize products, run their workflows, put these products on the blockchain, be able to distribute these products to investors, be able to manage them, manage the asset life cycle, and manage all of the settlement that comes back through that, right? And as I said, that's something that I kind of been focused on, over the last 6 months, really.
Right, and do you like, if we was to focus on like the 40%, for example, that are kind of not quite heavily involved across the blockchain, do you feel once there's a bit more of a lot more of financial products which are going to emerge as this starts to kind of develop, do you think that it's going to be a natural course that if they don't join the kind of blockchain parties, so to speak, they kind of really miss out on it? Where do you see that?
I don't draw any red lines like that. I mean, I don't think there are any ultimatums here, right? I mean, I believe that blockchain offers is one of the technologies that is part of the future of finance, and plays a significant role in the future of finance. And I don't think there's any missing the party here, right? I think we're still very early. I think in the context of a 255 trillion securities market, we haven't tokenized an awful lot of that, right, at this particular stage. So we're still very early. But what it demands of innovators in the market is to be coming up with better platforms to be able to serve those customers, those clients, those counterparties, so that they can actually put more sort of assets on chain, and to some extent start to transition some of their legacy traditional finance infrastructure into a more sort of digital and on-chain and native infrastructure. And that's certainly possible. And I think where the market has started really around stable coins, tokenized treasuries, around tokenized money market funds. And of course, we shouldn't forget that, HSBC have a tokenized deposit service. I think Signum and UBS have a Swiss franc deposit token. JP Morgan, the same. Citibank, the same. So there are certain, let's say, simpler use cases, including the money market fund examples that are given, like those that we see from Biddle, that they've been really useful in showing and illustrating to the rest of the market, look, this is the art of the possible. Now, I think the challenge with a lot of those early innovations, and we shouldn't, criticize them. I'll give all credit to forerunners. The reality of it is that they're extracting about 10 or 20% of the benefit. Why? Because they still have a lot of the legacy infrastructure sat around what they then place on chain, and they're not really extracting all of the benefit. But that will come in time. And I also don't criticize those that have sought to tokenize deposits, for example, right? Very, very important in terms of, improving payment rails in being able to offer this technology to clients. Money market funds, there are, I guess, more worthy asset classes, but at the same time, those are more complex. They will take more time to go to market, right? And so there are trade-offs to be thought of, right? Which is why I don't sort of heavily critique what's out there already. I know that sort of, let's say, more illiquid asset classes will come, and we will see the benefits of more of that 255 trillion securities market being recognized as eligible collateral. And today that's 28 trillion. So even if there's a 1% improvement in that eligible collateral pool, that's actually a massive change and a massive shift. It's really, really significant. So let's see. I think really something else I would say about tokenization, and we've seen it with stable coins, is really the way that money is able to sort of move around the globe. And we're no longer held to, T+1, T+2, even T+3 in some cases. And that's really amazing. That's forming the foundation for a much more efficient financial system. And equally, we'll probably come onto it, but kind of regulatory capital and the collateral that effectively needs to sit in order to meet, tier 1 ratios and so on. We can actually be unlocking more of that collateral and more of that capital over time because we're speeding up settlement cycles, right?
Yeah.
And no longer do I have to have a provision in a completely different continent for business being done in that continent. I can actually have highly mobile, highly fluid, highly liquid collateral placed anywhere around the globe and know that I can settle within minutes if required in another jurisdiction. And that has massive implications for cost, for competitiveness, for efficiency, for new products, new markets, new possibilities for clients, new possibilities for institutions.
Yeah, I kind of scribbled this down as we touching on this. So, what I was keen to understand is, do you think that essentially new token formats are really kind of dependent on advancements within KYC, and does it kind of run parallel, do you think, to really like you said, to continue these movements into these huge money spaces?
I think that basically a lot of the technology in terms of multi-purpose tokens, in terms of using certain token standards to achieve certain objectives or to represent certain products, is already there, right? And it might be tweaked, slightly improved here and there over the years, and no doubt go through significant transformation at some stage. But it's already there. So, for example, if you want to tokenize a particular asset, and you want the identity of the initial owner to be carried with those tokens, you can link kind of identity and asset ownership together already, right? There are standards to do that. So I think that we also need to think about KYC and AML processes in a much more distributed format. I mean, some years ago, my timing was horrible, but some years ago, I was talking to a number of consultancies and banks about decentralized KYC AML, right? Where client still has access to all of their identity information that you would usually ask for, or all of their documents if they were a legal entity of some sort, and the bank would no longer need to necessarily store these these, this data, these items, the client, the counterparty, would provide access to all of that data when required, on demand. And so you come to a much more decentralized, and that could be accessed from anywhere, right? And it could be that JP Morgan will access that at the same time as HSBC accessing that. And we'd see a much more efficient scenario than, let's say, having to provide the same suite of documents to the same 5 or 6 institutions, right? I would only need to provide them once. I would need to be able to manage the permissions around that, and then basically everything else that happens today would follow on. And under certain conditions, I wouldn't be able to prevent access to that information, and in other situations, I would be able to prevent access to that information because it's essentially somebody's sovereign information. Albeit that if you've already done transactions with a particular entity, particular institutions, then that institution is going to need access to your ongoing data, right? So in that situation, you would be able to borrow access or whatever. So my point really here is that we can actually need to also think about how we think about identity, how we think about privacy as well, because actually transactions is really, really important for institutions, and how we bring all those things together within the token identity. So essentially you have privacy, you have identity, and you have asset, all in the same kind of Venn diagram.
Right. Yeah. And we've covered quite a bit today. We've gone into various different elements across the topics, really bringing it back to kind of RWA specific tokenization. Do you think there are additional benefits, and what are they that we've kind of not been able to chat over so far?
Yeah, I think something I touched on, but I think it's really, really important. I think it's at least $100 billion opportunity, and it will grow. Is really, the reg cap advantages that tokenization offers. And I think that, when we consider that regulatory capital management is a significant undertaking by a regulated financial institution, and really defines how capital efficient they can be, what business they can do, what business they decide to decline, how operationally efficient they are. It's probably a multi-trillion-dollar opportunity, to be quite honest, right? And I think, when we look at tokenization and blockchain technology in particular, offers the opportunity for indirect relief under Basel regs. And I think with the same risk and the same activity, same regulation as we would consider within traditional finance, you're looking at reduced counterparty and settlement risk, right? The atomic settlement that I mentioned earlier, T+0 or near instant settlement, eliminates long exposure windows that we currently have in T+2 and T+1, and that then frees up capital tied in unsettled trades or collateral. When I post collateral, that doesn't need to be incredibly static. It can be particularly dynamic, and I think that right now you could consider $100 billion annually locked in repo and collateral markets, that's without any sort of cash redemption whatsoever. So we really, I think that's the minimum opportunity that we see. And I think that we could also look at optimizing risk-weighted assets. So fractionalization plus 24/7 trading improves liquidity, lowers illiquidity premiums, as long as we're able to properly represent these risk-weighted assets, and we're able to properly assess and risk manage these assets, we're able to then, if we can lower those illiquidity premiums and potential risk weights, because the risk weights relate to those illiquidity premiums directly, we can better enable like portfolio diversification, and we can then offer lower capital buffers for credit markets and our operational risk buffers and everything else, right? Therefore, markets become a lot more efficient, right? And then because we're able to manage our collateral better and our liquidity better, tokenized money market funds, bonds, private credit can be used as collateral in DeFi or TradFi without full redemption, reducing cash drags, all of these sorts of things. And at the same time as not forgetting regulatory obligations and supporting automated compliance. And lastly, you mentioned KYC. Well, that regulatory fit is really important. And obviously we've seen positive regulatory advancement in the US. We've seen positive regulatory advancement in the EU. And, I think when we look at blockchain's potential for inbuilt KYC, audit trails, kind of they ease those compliance burdens slightly. And I think that the risks, protocol risks, and smart contract risks, etc., are outweighed by the overall capital relief. They're outweighed by the opportunities and the operational efficiencies and the potential. What I would flip round and say is a opportunity for much improved liquidity, right? There's lots of other things I could say around. I think that in a way I've already said, operational efficiency gains, cost savings, automation, the speed, the transparency when required, the privacy when required, accessibility. But really, we're seeing a multi-trillion-dollar market in tokenized assets come to the fore. And depending on what paper you read, by 2030 or 2033 or whatever, people want to quote. But I see this as it's a $1 trillion opportunity into the double-digit trillion opportunities on the optimistic end. And if we get all tier 1 and all tier 2 institutions firing on all cylinders by 2030 to 2035, then that number of double-digit trillion could easily grow into the 100 trillion as well. I think that it's at the moment tokenization is incremental. There won't be any big bangs. There won't be any fundamental overnight changes, but it is a structural shift, right? And I think it's positive in terms of reducing regulatory capital burdens, as it is, unlocking trillions in trapped capital value. And I think it's probably one of the largest opportunities in modern capital markets, is how I'd sort of finish off and kind of frame that.
Nice. Yeah, I mean, that's, I think, we've covered so much ground there. I've been scribbling some really illegible notes apart from for myself here. And that I just wanted to say, look, thanks again. I think, one of the big draws for me of kind of starting the podcast was really to try and, one, from a selfish perspective, understand a lot more, and two, just introduce what I feel, not so much probably yourself, you've been in the game for a long time, but emerging areas, and kind of staying on the cusp of things, and I feel it's just really exciting. The kind of those figures there are just astronomical, aren't they? What the potential is of these areas, and like you said, the KYC and the regulatory elements. It's kind of it's the responsibility of the kind of the builders now, isn't it, to make sure that they're really taking this as seriously as they need to maintain this growth and maintain the kind of, well, essentially making it more accessible to the masses, really. So yeah,
it's important not to over egg it at this particular point. I stand by what I just said in terms of positioning. It's one of the largest opportunities in modern capital markets. Absolutely. Right now, we've tokenized in the hundreds of billions. I don't think we're quite near $1 trillion. I mean, certainly real estate, other tokenized RWAs, I think certainly probably done at least 600 billion. Repos, and that capital unlock, I think probably responsible for another 200 billion, just approximately. So I think we've got to get into as we saw in crypto, actually, in order for it to really be taken seriously, we've got to get into that kind of multi-trillion dollar phase that we will see by 2030 or maybe just before. And then we'll see it fly. This period now, 2026, 2027, are key to hit that $1 $2 trillion mark, and I think we'll see that across multiple asset classes. And yes, so a lot of the benefits that I've described will be borne out.
Well, look, I mean, we'll wrap it up there. And what I will say is, for 100% is, from my perspective, love to have you back on in the new year, and really probably focus on a different element, maybe stable coins, and sort of see where we are, because what happened last week is so different to this week in that space, and it's emerging so quickly, isn't it? As being dubbed the next gold rush and whatnot. So let's explore that further down the line. But look, thanks very much, and look, really do appreciate taking the time out today. So
it's my pleasure. Yeah, well, thanks, Toby. I really appreciate it, and I'll speak to you in a few weeks.
Brilliant. Well, look, I've just done that. So great